So what are the different sources from which credit can be obtained? There are multiple sources of obtaining credit, and in this video I am trying to cover all those sources. So this is bound to be a bit longer video, so please bear with me and watch it till end to understand all the sources from which credit can be obtained. So this is the list of all the different sources from which the credit can be obtained. I'll first put up that list and later go into the details of each of these sources of credit. The first one is friends, family and fools. The second is commercial banks. The third source is non-banking finance companies. Fourth source is development financial institutions. Fifth source is government, PSUs and central bank. Sixth source is public debt markets. Seventh source, trade credit. Eighth source, multilateral institutions. Ninth source, insurance companies. And 10th source, pooled investment funds. Now let's look at each of these sources of credit in detail. Friends, family and fools. This is the first port of call for any entrepreneur trying to set up the business. We approach our friends, we approach our family and we approach fools. Those people who trust us, they somehow like us and they believe in us that we will repay their money. Typically, these sources will extend you very small amounts because they also cannot afford to invest big amounts and they are not professional lenders. The most important criteria behind their giving credit to us is their trust in us. They are confident that come what may, this individual or this businessman or this business will try to pay back the debt. These terms you get typically on flexible conditions. Many times there is no documentation, there is no exact repayment criteria, or for example there is no implicit rate of interest in that particular transaction. So friends, families and fools are a source of credit that should not be relied upon for long term and ideally should not be even resorted to. But the reality is most of the business people, when they start, they do obtain friends, family and full support by way of credit. One of the most important sources of credit in today's economies is commercial banks. The core business of commercial banks is lending, and therefore they have all the setup required to become very good at lending. Maybe it is from sales, underwriting or risk management, documentation as well as monitoring of the credit subsequently. Often, lending makes up to 2/3 of the asset of the commercial banks. The commercial banks are the biggest source of credit for individuals as well as for various businesses, be it small, medium, micro businesses as well as the corporates. The commercial banks lend money for short term, for example for 6 months, as well as medium term, for example 3 to 5 years. Typically, commercial banks are unwilling to lend for more than 5 years and also they are not willing to lend unless they get the collateral or a security. Managing the asset and liability match is very important in commercial banking because most of their liabilities are in the form of short-term deposits whereas their assets are locked up for 1 year to 5 years. Commercial banks can be divided into private sector banks, public sector banks, foreign banks, cooperative banks, payment banks, small finance banks, etc. Commercial banks have been coming up with a number of innovative instruments over decades to help service their customers and to grab a larger market share. The commercial banks have been classified by RBI and by many other central bankers as systemically important commercial banks and systemically not important commercial banks in order to manage the risk in the financial system. The third important source of credit is non-banking finance companies, which are also governed by the Reserve Bank of India. They cannot raise demand deposits from the public or a check cannot be issued on the NBFC. So NBFCs are basically not licensed as banks. So they have certain limitations. NBFCs are also tightly regulated by RBI. For example, they have capital adequacy norms, they have prudential norms for income recognition, etc. The NBFCs are classified as deposit-taking NBFCs and non-deposit-taking NBFCs, and accordingly there is a tighter governance norm prescribed by the RBI for deposit-taking NBFCs. NBFCs are of various types. For example, there are asset financing NBFCs, lease and hire purchase NBFCs, investment NBFCs, and so on and so on. Non-banking finance companies are by very nature more flexible in product creation, targeting the customer as well as servicing the customer, and that's how they differentiate themselves from the bank. The RBI has classified NBFCs as well as systemically important and other NBFCs depending on their balance sheet size. The fourth source for raising credit is basically development financial institutions. In India, we had development financial institutions like IFCI or Industrial Financial Corporation of India, IDBI, Industrial Development Bank of India, and ICICI till 1990s. However, all of them have now converted into banks, and therefore we don't have this concept of development financial institutions now, except small sectoral development institutions like SIDBI, etc., which I will talk about separately. These development financial institutions were an important source of long-term finance for lot of corporates. For example, they could place bonds with these DFIs for as long as 10 to 15 years. Now, obviously, when they are converted into commercial banks, they are not willing to take the exposure of 10 years or 15 years. Another source of credit is government, public sector undertakings, as well as the Central Bank of India, which is RBI. The government funds various enterprises through its schemes. For example, SIDBI or Small Industries Development Bank of India works closely with MSME Ministry to make sure that the small enterprises get adequate credit. Likewise, there is NABARD, which works with various ministries to make sure that the agricultural and rural communities get adequate credit and other support. Public sector undertakings under government extend credit to their vendors and suppliers to build their scale. Reserve Bank of India, the central bank, makes sure that the banks have adequate funds with them and is responsible for credit expansion in the economy, as well as other objectives like implementation of monetary policy and control of inflation. Public debt markets is another source of credit for various corporates and other enterprises. Public debt markets are used in some of the economies, like for example in Europe as well as in US. Our market does not have that much of a depth as well as breadth. So corporates rely heavily upon banks, or they directly raise equity from the public. Public debt market instruments are typically bonds, and bonds can be issued for short term as well as for long term. Large, well-established companies with good credit rating can, for example, issue commercial papers. They are to be compulsorily rated by the credit rating agencies at a certain level. But these help these companies cut down on the intermediation costs. They don't have to necessarily go to the banks. They directly go to the other companies or other businesses or investors who have adequate funds, and the cost of intermediaries is cut down, and therefore both the parties benefit. Raising funds in the foreign debt markets is another part of the public debt markets, and these funds are raised, for example, by issuing foreign currency bonds. Trade credit is one more source of raising the credit. For example, typically the manufacturing companies or engineering companies, capital goods companies extend credit to their customers. This credit is not extended for long term. It is extended for, let's say, 30 days, 60 days or 90 days, that is 3 months. However, some of these companies also have their financing arms, which give the credit to the customer for as long as 5 years. The fundamental objective of giving trade credit is to make sure that you get the business from the customer, because without giving trade credit, you might lose the business to your competitors. So business growth is the main objective and not the extension of credit or earning of interest. Most of this credit does not have interest incorporated inside that, except when the customer delays. Of course, you have to take your cost of funds into account when you set the price for the customer. Another source of raising credit is multilateral financial institutions. For example, World Bank, IMF or International Monetary Fund, Asian Development Bank or International Finance Corporation. Also, there are certain governments which give credit to projects in other countries. For example, the government of Japan has extended credit to bullet train project in India. The credit is for a very long period of, I think, 50 or 60 years. There are some of the rich companies or family-hold enterprises which also extend credit to some of the projects that fulfill their agenda. In most cases, the objective of extending credit by the multilateral financial institutions is not just financing, but for example, creating infrastructure in certain economies or poverty alleviation. Insurance companies are another source of credit. Insurance companies need to invest the funds which they have got from the insurance policy holders, and these funds are available with the insurance companies for long term. So they are looking for long term sound instruments or investments where they can get a reasonable return. Also, the insurance companies have to follow the norms laid down by the regulator. Like for example, IRDA, Insurance Regulatory and Development Authority in India, has norms for where insurance companies can invest and how much. So those norms have to be taken into account by the insurance companies when they take their investment decisions. Pooled investment vehicles are one more way of obtaining credit. What is a pooled investment vehicle? It's a company where a lot of investors come together, put their funds, and as per the understanding, those funds are managed and return is provided. Examples of pooled investment companies include mutual funds or mutual funds which are investing specifically in debt assets like money market mutual funds. These are one of the big sources of credit nowadays for the corporates as well as the others. The alternative investment funds like private equity and venture capital are also a source of credit. Typically, they invest in convertibles, which could be debt to start with and might later convert into equity at terms that are agreed in future. Another source of alternative investment fund credit is hedge funds. Hedge funds typically take very high risk as per their risk strategy, and they might invest in, for example, junk bonds or the bonds that are very low rating where the companies are likely to default. So I hope in this video I have been able to cover all the sources and you have understood different sources of raising credit. If you like this video, please subscribe to my channel and comment in the box if you have any other questions. Thank you very much and cheers.